Welcome to the Deep Dive, your shortcut to becoming truly well-informed. Today, we're diving deep into the world of corporate financials. We're pulling back the curtain on DCM Shriram Ltd. Specifically, we're going to unpack their first quarter results for the fiscal year 2026. That's the period ending June 30, 2025.
And we're going right to the source documents for this deep dive. It's a mix, really. You've got the formal regulatory filings, the unaudited standalone and consolidated financials, but also their, let's say, more digestible results presentation.
Right.
Our mission today, cut through the numbers, the jargon, give you the crucial takeaways. We want to understand what really happened in DCM Shriram's, well, quite diverse businesses this past quarter.
Yeah, what do their strategic moves actually mean? And what are they looking at for the future?
Exactly. We're getting you well-informed and quickly. That's the goal.
Absolutely.
Yeah.
And just to set the scene a bit, these results we're talking about, they were thoroughly reviewed, considered and approved by the board of directors. That meeting was on July 21st, 2025.
And it wasn't just a quick in and out.
No way. It kicked off at 12:30 p.m. and wrapped up at 4:45 p.m. That's a full afternoon of serious discussion.
That length tells you something, right? There's likely a lot to chew on. And it's also important, I think, to touch on the audit process here. Deloitte Haskins and Sells LLP did what's called a limited review of these unaudited results.
Okay, so what does limited review actually mean in practice? Is it like a full audit?
Not quite. It's not a full comprehensive audit opinion. Think of it more as providing a certain level of assurance, like a quality check.
Okay.
They're basically saying, look, based on our review, nothing jumped out at us that suggests these numbers are materially misstated. It's a reviewed snapshot, confirms consistency, gives investors, a degree of confidence.
Got it. So let's jump right into the big picture then, because at first glance, these are some seriously strong numbers. Looking at the consolidated highlights, Q1 FY26 compared to Q1 last year, FY25, the overall growth looks pretty impressive. Consolidated revenue from operations, the top line surged to Rs 3,455.2 crores.
Right, up from Rs 3,073.0 crores.
That's a solid 13% jump year over year.
And that 13% revenue jump, it isn't just a number floating in space. It kind of positions DCM Shriram as a bit of an outlier in its diversified industry.
How so?
Well, it suggests their multi-sector strategy is really delivering resilience. They seem to be outperforming many peers who are still, grappling with inflationary pressures and maybe slower demand.
Okay, that makes sense.
And beyond just the revenue, if you connect this to the bigger picture, their financial health indicators look good too. They suggest a company that's growing while keeping things stable financially.
Like what, for instance?
Take the debt-equity ratio. It stayed remarkably stable. 0.21 in Q1 FY26, almost identical to 0.22 last year.
Okay, 0.21. What does that actually tell us?
Think of it this way. For every rupee of their own money, their equity, they've only borrowed about 21 pays. That's very conservative. It signals a strong balance sheet, prudent management.
Wow, okay. That is a great sign. And it seems to get even better when you look at profitability. Consolidated profit before interest, depreciation, and tax PBDIT that soared significantly. Rs 325.7 crores.
Up from Rs 273.7 crores. That's a 19% increase year over year. Big jump.
19%. And the bottom line, consolidated profit after tax, PT, also saw a healthy rise. It hit Rs 113.8 crores.
Compared to Rs 100.3 crores last year, so that's up 13% year over year as well.
So both PBDIT and PATI showing strong growth.
Exactly. And PBDIT, it's often seen as the purest measure of a company's operational strength. Before financing costs, before accounting deductions kick in.
Right, the core operations.
Yeah, that 19% leap tells us the core businesses are generating significantly more cash from their day-to-day activities, which is frankly a fantastic sign.
And what about covering their debt costs?
Good question. Look at their interest service coverage ratio, also looking incredibly healthy. For this period, it jumped dramatically, 11.42 times in Q1 FY26.
11 times. Compared to what last year?
It was 7.87 times in Q1 FY25. So a big improvement. It means they can cover their interest payments more than 11 times over with their current earnings.
That's very robust.
It is. It's a strong indicator of financial health, reassures lenders, signals very low default risk.
Okay, so those consolidated numbers are definitely painting a positive picture. Financially robust company. But, as you mentioned, DCM Shriram is really diverse.
Very diverse.
You've got the agri-rural side, sugar and ethanol, Shriram Farm Solutions, bioseed, fertilizer. Then, chemicals and vinyl. And the value-added segment, finesse to building systems.
Quite a mix.
So now let's peel back the layers, go segment by segment, see where this growth is actually coming from and maybe what challenges popped up. Let's kick things off with chemicals and vinyl. That seemed to have a particularly strong quarter.
It certainly did, yeah. The chemicals and vinyl segment revenue jumped to Rs's 114 crores this quarter,
Wow,
from Rs 842 crores in Q1 last year. That's a huge 32% increase.
32%. Okay.
Yeah.
And profit?
The operational profit, the PBIT for this segment, wasn't far behind. It rose 31%, hitting Rs 185 crores from Rs 140 crores.
That's a massive surge on both top and bottom lines for that segment. What were the key drivers? What pushed that?
Well, a big part of it was caustic soda. Volumes were up an impressive 20%.
20% volume growth. Why?
Mainly due to capacity expansion. They reached 850 tons per day capacity. And critically, they also saw higher ECU electrochemical unit realizations. Those were up 8%.
Okay, ECU realization. Break that down a bit.
Essentially, it means they're getting better revenue for every unit of electricity they use in their chemical production, selling their output at more favorable prices, basically.
Gotcha. Better prices, more volume.
Exactly. And combine that with lower power costs, partly thanks to efficiencies from their new 120 milliW power plant, and you've got a powerful tailwind.
That new power plant sounds key.
Oh, it is. It's not just about saving costs this quarter. It fundamentally shifts their energy independence, could insulate them from future energy price swings, giving them a real long-term competitive edge. And one more thing on profitability here.
Yeah.
There was a one-time positive impact last year, Q1 FY25, of R16 crore from an electricity duty reversal. So if you factor that out, the underlying earnings increase this quarter is actually even more significant than it looks at first glance.
Good point. So they're becoming more self-sufficient, more efficient.
Yeah.
But was it all, smooth sailing in chemicals and vinyl? What about the vinyl side, PVC specifically?
You're right to ask. That's where things were a bit tougher. While PVC volumes were actually up 12% year over year,
Get volume up.
prices were down, noticeably down by 17%.
Ouch. 17% drop in price.
Yeah. And similarly, carbide volumes were up 19%, but again, prices dipped down 3%.
So higher volumes but lower prices really squeezed margins there.
Exactly. It led to a lower PBDIT specifically for the vinyl part of the business. That came in at Rs 23 crores compared to Rs 47 crores last year.
Quite a drop.
And remember, that one-time positive impact last year we mentioned, that RTES 16 crore electricity duty reversal. That also made last year's vinyl number look comparatively stronger, contributing to the size of the drop this year.
Right. So a tough pricing environment for vinyl then. Is there any relief potentially on the horizon for PVC prices?
Possibly. There's been a development. The Supreme Court recently issued an interim order. It clears the path for an anti-dumping investigation into imported PVC.
Anti-dumping. That could change things.
It could. If this leads to tariffs on imports, it might bring some much-needed relief to domestic prices. Level the playing field a bit for Indian manufacturers like DCM Shriram.
That would definitely be significant. And strategically for chemicals, they're making some interesting moves too, right? Like acquiring Hindustan Specialty Chemicals.
Yes, the agreement to acquire 100% of HSCL. That pushes them into advanced materials and epoxy. A definite value-add play.
And the ECH plant.
Right, the epichlorohydrin plant. That's already started trial runs. Full commissioning is expected this very quarter, Q2 FY26. These are certainly forward-looking moves into, well, higher value chemical segments.
That seems like they're positioning for the future there. Okay, let's shift gears. Sugar and ethanol. Sounds like this segment faced some pretty significant headwinds this quarter.
It certainly did. Yeah, headwinds is the right word. Revenue was down 14%, came in at Rs 824 crores this quarter.
Down from ball.
Rs 956 crores in Q1 last year. And even more starkly, the PBIT, the profit for the segment, it swung pretty dramatically.
How dramatic?
From a positive Rs 10 crores profit last year to a negative Rs 37 crores loss this quarter.
Wow, from profit to loss. That's a sharp reversal.
Yeah.
What drove that? In a segment that's usually pretty vital for them.
Well, a major factor was domestic sugar. Volumes were down quite a bit, 23%.
Why were volumes down so much?
Lower offtake, apparently, even though prices were actually a bit better, up 4.3%. But the big hit, the really impactful one, came from ethanol.
Okay, what happened with ethanol?
Volumes were basically flat, prices up just slightly. But they got slammed with a negative one-time impact, a big one, Rs 36 crores.
36 crores. What was that from?
This wasn't just a new tax. It was a retrospective levy. Duty on ethanol they had exported outside Uttar Pradesh, effective all the way back from 2018.
Wait, retrospective. Back to 2018.
Exactly. Imagine suddenly getting a bill for a tax from 5 years ago on past exports. It's a huge, unexpected hit to the bottom line. Really messes with long-term planning.
I can imagine that sounds incredibly difficult to manage.
It really does. And the company is actively calling for a comprehensive review, a reform of the whole sugar policy landscape. The industry is even exploring legal options.
Yeah, it really highlights how unpredictable policy changes can just sideswipe a business, doesn't it?
Absolutely. It raises serious questions about stability for long-term investment in that sector.
But amidst those headwinds in sugar and ethanol, was there anything positive?
Yes, there was a bright spot. Their compressed biogas plant, the CBG plant at Ujjapur.
The new one.
Yeah, commissioned only in March 2025. It's already operating at roughly 90% capacity utilization.
90% already. That's a remarkably quick ramp-up for a new facility like that.
It is indeed. Shows good execution there. Okay, next up. Fenesta Building Systems, their windows and doors business.
Right. How did Fenesta do?
This segment showed healthy revenue growth, up 21%, reaching Rs 248 crores in Q1 FY26.
Okay, 21% revenue growth. That sounds good.
It is, up from Rs 215 crores last year. However, despite that growth, the PBIT, the profit, remained relatively flat. Rs 27 crores this quarter versus Rs 28 crores last year.
Huh. Flat profit despite strong revenue growth. That's interesting. I saw their volumes were better in both retail and projects, and the order book was up 12%, so demand seems strong. Why the flat profitability then?
That's a crucial point. The PBDIT stayed flat mainly because fixed expenses were higher.
Higher costs eating into the profit.
Well, yes, but it wasn't necessarily a problem. It was apparently part of a deliberate strategic plan. They're investing.
Investing in what?
Strengthening their capabilities, their brand positioning, setting up newer revenue platforms for the future. So what you're seeing isn't really a hit to current profitability, but more like an investment for future growth, establishing new market positions.
Ah, okay, so it's strategic spending, not just inefficiency. That makes sense. And speaking of strategy for Fenesta, they made that acquisition, right? DNV Global.
Exactly. They acquired a 53% equity stake in DNV Global Private Limited. That's a hardware company.
Seems like a smart move. Backward integration, new revenue stream.
Oh, potentially. It definitely strengthens their supply chain and opens up a new platform.
Okay, let's move to Shriram Farm Solutions. How's the agri-input side looking?
That business is certainly cultivating growth, you could say. Revenue for Q1 FY26 was up 29%.
29%, nice.
Yeah. Hit Rs 350 crores, up from Rs 271 crores. And PBIT also grew nicely, up 23% to Rs 23 crores from Rs 18 crores last year.
Good growth on both lines. What drove that?
It was largely volume-driven growth, especially strong performance in crop protection and nutrition products. Good to see the core business doing well there.
Definitely. Were margins strong too?
Margins were indeed higher, yes, but they were somewhat moderated.
Moderated by what?
By increased spending on marketing and R&D. Again, this reflects a conscious investment. They're strengthening the Shriram brand, pushing new products.
How many new products?
They launched 8 new ones this quarter alone, including 2 developed from their own in-house R&D.
8 new products? That's quite proactive, investing in the future pipeline.
Exactly. Key for future market share and profitability in that space.
Okay, now on to fertilizer, specifically urea. This segment also showed some impressive efficiency gains, didn't it?
It did. Revenue was up 19%, hitting R3 90 crores from Rs 328 crores. And the PBIT saw a really significant jump, 75% increase.
75% profit increase. Wow, what fueled that?
Reached Rs 35 crores, up from Rs 20 crores. A big part of that surge was higher volumes, partly because there was a maintenance shutdown in the prior year, Q1 FY25, which depressed volumes then.
Ah, so a favorable comparison base, partly?
Partly, yes. But also, lower gas prices helped significantly. Gas prices dropped to $13.09 per MMBtu from $15.03 last year.
And gas is a major input cost for urea production, right?
Huge cost. So that drop is a significant saving, directly boosting profitability. Better energy efficiency also played a role.
Any one-off items impacting the fertilizer holders?
Yes, good to note those. There were positive one-time impacts in both years, actually. In Q1 FY26 this quarter, there was Rs 24 crores from an FY 2023 retention price revision, basically an adjustment for past periods.
Okay. And last year?
In Q1 FY25, there was a Rs 20 crore positive impact from a marketing margin recovery. So you need to keep those in mind when looking at the underlying trend.
Got it. It's always good to understand those nuances. Now, one factor that always comes up with fertilizer is subsidies. How does that look?
Still a very significant factor, yes. As of June 30th, 2025, the outstanding subsidy receivable from the government was Rs 236 crores.
Wow, 236 crores. How does that compare to last year?
It's up quite a bit from Rs 133 crores at the same time last year. So while it represents money owed to the company, it's a crucial working capital consideration. Ties up cash.
Right, managing that cash flow is key. Okay, finally, let's look at BioSeed. Their research-driven seeds business, how do they fare?
BioSeed delivered very strong results this quarter. Really robust performance. Revenue was up 30%.
30%.
Yeah. Hit Rs 284 crores, up from Rs 218 crores. And PBIT absolutely soared up 50%. Reached Rs 40 crores from Rs 26 crores last year.
50% profit growth. That's huge. What drove that?
Strong demand across most crop segments, particularly corn and paddy, were standouts. And importantly, they achieved better margins in those specific areas too.
Better margins on top of strong demand. Good combination.
Definitely. Though it's worth noting some of the volume gains were apparently due to timing differences in sales compared to last year. But overall, a very positive quarter for BioSeed.
Any weaker spots within BioSeed?
Yeah, their overall performance was slightly impacted, partially, by lower volumes and margins, specifically in cotton. But corn and paddy really carried the day.
Okay. And just quickly, there are other smaller businesses, cement and Horiali.
Right, quick mention. Cement saw revenue up 8%, but its PBDIT was actually negative. Horiali, their rural retail chain, had revenue down 10%, though PBDIT was roughly flat. Smaller scale, but part of the overall picture.
Okay. So we've gone through the numbers segment by segment. Let's step back again. What's the management's broader take on all this, their commentary?
Well, Ajay and Vikram Shriram put out a joint statement. They acknowledged the, challenging global economic climate, growth just hovering above recessionary levels globally.
Yeah, trade tensions, market volatility.
Exactly. All contributing to a pretty precarious global economic environment, as they put it.
But there's always a but with India these days.
Precisely. They highlighted the powerful counterpoint. India is rapidly, as they say, consolidating its place as the fastest growing large economy.
And projected to continue that.
Yes, projected to continue this strong trajectory, attracting significant investment, fostering innovation domestically. It's that contrast, global headwinds versus strong domestic tailwinds.
And how does that translate into their strategy? You see them balancing these two.
I think this is where their strategic thinking really comes into focus. They've been incredibly active with investments. They completed several key projects just in FY25 and the start of this fiscal year, FY26.
We touched on some of these. The caustic expansion.
Right. The 850 TPD caustic capacity expansion at Peruch, commissioned May 2024. The 120 milliW power plant there, June 2024.
The hydrogen peroxide plant, too.
Yep. H2O2 plant, August 2024. They also expanded sugar capacity at their Loni unit in November 2024. And as we mentioned, the CBG plant at Ajbapur got up and running in March 2025.
Plus the Finesse acquisition we just discussed.
Exactly. The 53% stake in DNV Global PVT Ltd in May 2025, bolstering Finesta. And they're not stopping there. Their pipeline looking ahead is quite full.
What's coming up next?
Well, the epichlorohydrin, the ECH plant, and that acquisition of 100% of HSCL both are expected this quarter, Q2 FY26. So very soon.
Okay, so immediate next steps. What about further out?
Looking further out, Q4 of this fiscal year, FY26, they expect the Finesta aluminum extrusion plant to be ready. And also a 68 milliW captive renewable energy project for their Coda facility.
Renewable energy, interesting.
Definitely part of their sustainability push. And then into early FY27 Q1, they're projecting additional capacities for aluminum chloride and calcium chloride.
So they're clearly not resting on their laurels. They are actively building, investing across the board.
Absolutely. Which raises, I think, an important question for listeners to consider. How are all these significant capital expenditures spread across such diverse segments? How are they intended to drive long-term value? And how do they align with their stated sustainability goals? It looks like a multi-pronged strategy in action.
That's a critical point. And their overall strategic direction, the vision they state, it seems to tie into that.
It does. Management talks about leveraging their robust balance sheet, which we saw evidence of in the ratios, advancing into adjacent business areas, both organically and through these acquisitions we've discussed.
Growth and expansion.
Yes. But crucially, they also emphasize embedding sustainability at every stage. They see that as key to securing responsible long-term growth, not just growth at any cost.
Right. So there you have it. We've taken quite a journey through DCM Shriram's Q1 FY26 performance. Started with those strong overall financials.
The headline numbers looked good.
Then dove into the segment-by-segment details, highlighted the growth drivers, like caustic soda and bioseed.
But also the challenges, particularly in sugar and ethanol, with that retrospective levy and the price pressures in vinyl.
And we looked at their ongoing strategic investments, painting a picture where they're heading.
So maybe a final thought for you, the listener, to ponder. DCM Shriram is clearly making big bets. Forward integration, diversification within their core strengths. They're doing this even with all the global economic uncertainty swirling around.
Right, leaning into the India growth story.
Exactly. So as India likely continues its strong growth path, how might these recent acquisitions, HSCL, DNV Global, and their deliberate investments in things like green energy, the CBG plant, advanced materials like ECH, how might all this truly position them? Not just to navigate the volatility, but to unlock totally new growth frontiers in the years ahead.
A lot to think about there. How those pieces fit together for the long haul. We hope this deep dive has left you feeling well-informed, maybe with some surprising insights into what it takes to drive growth in such a diverse conglomerate today.